Good morning. It's Thursday, March 13th, about 6 a.m. Central Time. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. One of the stories that I found really interesting and quite funny here was that Canada, they slapped a counter tariff of $21 billion and it covered a lot of different items. 539 new items were on that list here, and one of them was golf balls and golf equipment. And I'm just wondering, if a golf ball normally costs, say, $5 to $10, what if it goes to $100 or $200 per golf ball? Will people be able to play better? They're going to be not hitting them in the water, not hitting them out of bounds, and would just the game itself improve as far as quality of score and players? So just something off topic here for the moment, but let's get into it here. So the volatility, it continues in the equity markets, even as the CPI came in month over month, 0.2% versus 0.3 expected, and the CPI year over year was 2.8% versus 2.9% expected. We saw some wild volatility in the U.S. market yesterday. Futures surged on that number as a relief rally came in, but a lot of discussion about the potential government shutdown over the weekend and the ongoing uncertainty around the American economy really weighed into the markets. We saw the treasury yields, they shrugged off the cooling inflation and they started to edge higher here, and really the focus is still on the effect of the higher tariffs and the potential on prices coming into the coming months here. So the Federal Reserve, it's going to meet next week here, but they've already signaled that they want to take a wait and see approach before cutting rates later this year. So what we were looking at was, did the interest rate cut expectation jump in May, or is it still anchored at June? And it looks like it's really still anchored at June. Now, I did have quite a few people call in yesterday, and they're really asking me more about my process and how I come up with different ideas in the markets and kind of what my daily routine is. One of the things that I do always look at here is like the performance leaders. And from the day before and at the end of the day, I'll get a report sent to me on what are the top 5 commodities out there from the best performers and then the worst performers. And then what I'll ask myself is, was there a significant change in that underlying commodity? And am I involved with that particular commodity? Like crude oil yesterday was up 2.16%. Many of the clients working with myself are long the crude oil market at the moment here. RBOB gasoline saw a lot of people add into that breakout here. Silver futures up 1.8% here. And finally, copper up 1.75. And we've got a lot of exposure to those commodities. Now, one of the laggers here, natural gas, that's one that we've talked about on this channel where we had this topping formation in there, and that was your worst performer yesterday, down 8.29%. Many people short that commodity. Many people were covering into the close yesterday and covering into the overnight. Something interesting here is that the VIX was one of the worst performers as well. And when you see the VIX, we talked about volatility yesterday, as that starts to die down, that's where you get that bottoming process in the market, down 4.6%. Then you look at Ether futures and canola. There was this Chinese tariff here, 100% on all Canadian canola, and that's why we're seeing canola futures really fall. The next thing I do is I look at a volatility adjusted model that I created. This goes into the Metals Edge, and what I've been doing lately is people keep asking me about levels here as far as buy and sell points on different commodities or significant levels. And what I'm doing is I'm highlighting some of those levels where you might want to look at adding to positions incrementally or taking positions off. Something to note on this volatility adjusted model is that today's tactical resistance 3-point on the gold market is over $3,000 an ounce. I've only seen that a couple times, which it tells you that it's back in the radar. When it comes into the model, it tells you what the probable price ranges could be under different surges of volatility. Something else I'll do is I'll go through the various charts. I'm not going to break down each one of these, and I'll identify different key levels here, different levels of significance, and where I would consider adding or taking off for clients that I'm working with very closely. So just a couple things on the process. Another thing I'll do is I'll ask myself 3 questions like, is the market bottoming? Are we on the way to $3,000 in gold? And is this breakout in silver confirmed? So those are just a couple things here. So overnight here, we're seeing kind of a mixed reaction in a lot of these markets here, and they're kind of holding their breath against some of the key events that are coming out. We've got Eurozone industrial production. We've also got US PPI and the initial claims all coming out here today. We've got University of Michigan sentiment coming out tomorrow. Now, looking at the precious metals, gold is pushing towards that $3,000 mark at the moment. One of the systems that I follow closely here that helps me stay on the right side of the trend, and I suggest that many of you implement that in your own process. What keeps you in check? What prevents you from fighting a trend and just going with the trend? Remember, Bruce Lee said, be like water, flow like water, and that's what you really want to do on these markets. So on the gold market, the system that I particularly follow had triggered into another long position here after a period of about a week to 2 weeks where we couldn't really break out. Remember, we kept coming up to that critical level that I monitor, which is 29.3150. I've talked about that several times on this channel here. And what's key is that when you get a breakout on a particular system and a direction, that the next day it kind of opens and holds in that direction for the first 60 minutes or some kind of period of time that you feel comfortable with your own type of trading time frame. So I'm going to be monitoring, hey, once the market opens, is gold able to sustain this higher level, or is it going to retreat and give me a false signal here and go back into a consolidation zone that we've seen here so often? Now, gold is pushing towards, again, it is up $8.50 here today. The citing is that U.S. inflation had cooled, trade tensions are escalating, and we're seeing a lot of banks here raise their forecasts. Now, why are the banks raising their forecasts? Well, they're citing central bank buying and the inflows that are coming into the exchange-backed traded funds. Now, we'll check on that in a moment here. And gold is one of the strongest commodities here, performing commodities this quarter. We saw that Macquarie Group, they said that a possible spike to 3,500 could happen in the second quarter. They believe that gold futures will average 3,150 an ounce over that particular period in the second quarter. We saw Goldman Sachs, they raised their year-end target to $3,100 an ounce. I think that they're a little bit, they'll most likely increase that once we get closer to those levels, citing that some of the dynamics might have changed here. And then we also saw Citigroup, they raised it in February to $3,000 an ounce, but they said that would happen within the first quarter. So we'll see if they get that prediction here right. Now, overnight price action in the precious metals, you do have April gold up $8.60, $29.55. High of the session, $29.57, low $29.42. So not a lot of volatility there. Silver essentially unchanged, $33.73 and a half. The overnight high, $33.84 and a half. The low, $33.43 and a half. We've got copper futures down 1. We've got platinum futures. That's kind of the big mover and shaker here. And one of the charts that I do look at in the platinum is that it is in this giant wedge pattern. It tends to have been coming up to it, and then it cycles back lower. So that's down $13 at $9.81. And then finally, the gold-silver ratio at 87.5 to 1. I am going to put down all the pivots to support the resistance levels. That goes into the metals edge. And then I might include some of these charts here and some of these key levels that I'm looking at. Now, getting back to where they were saying that, they're increasing their price targets because of the fact that we've got these exchange-traded flows here. Well, exchange-traded funds, they added 109,000 ounces of gold here yesterday, bringing this year's net purchases to 3.41 million ounces. Now, what happened in the silver market? Well, silver futures, ETFs actually cut 1.2 million troy ounces of silver yesterday. What does that tell you? Well, if you look at the technicals on the chart, silver was approaching this breakout point. A lot of people were looking at, hey, we've been through this case before here. This is kind of a do or die situation for the gold market, and they took profits against that trend line and the resistance point here. Right or wrong, remember, everyone has their own agendas when it comes to trading. You look at the year-to-date performance on the ETF flows, gold up 4.1%, silver futures down 1.4%. So again, all these little rises we get in the silver, we're seeing them pull it out of the exchange-traded funds, perhaps deploying their capital into other things here, like some of the large cap, some of the different stocks that once we get that bottoming pattern here, where will the institutional flows coming into the markets here? Now, checking on the stock market here, I did have some numbers, and I do keep a notebook, and this is what you guys should do as well here. And I looked at, what's going on with this sell-off here, and are we really in trouble? And it's, the speed of the slump is what's caused the panic in the markets. I have received so many phone calls from people that I haven't talked to in months, if not years, calling me up and saying, hey, should I flush everything out of my 401k? Is this recession really coming, and things like this? Well, I viewed this, and I talked about this over the last couple of days, that I really view this as really a buying opportunity. This is one of the reason why I'm getting so many phone calls like this from different people, is because this is the fifth fastest sell-off from 52-week highs to a 10% correction that we've seen dating back all the way to 1950. And Tom Lee, he put out a note on it, and I get the notes from most of the banks, most of the analysts, most of the key people here, because I'm friends with a lot of these people and they like to share them with me. So if you look at different speeds, the fastest we ever saw was when everything was starting to get lift off in 2020, and then all of a sudden COVID, we were hitting a 52-week high, and then the effects of COVID took place, and in 8 days we sold off 10%. We saw a decline here. Now the second fastest was in 2018, took 13 days. Then you got to go back to some way farther dates, back into the 50s and things like that, which I don't think are relevant at the moment. So realistically, this is probably the third fastest 10% decline we've seen, and it's occurred over 20 straight days. And I think that the 20 days of the sell-off is really what's kind of weighed in with people. People are trying to buy the bottom, thinking we're staying in that channel, and then what happens is the volatility breaks out on the VIX and things break down. Now we saw the VIX overnight here starting to come off just a little bit, so I think we're trying to form some kind of bottoming pattern. Now if you look 3 months later, after each one of these major sell-offs here, not including today because we don't know what's going to happen here or when this decline is going to occur, but 3 months later, the average gain from the lows was 9%. 6 months later, we were up 76% of the time with a recession, and 86% of the time without a recession. We had recovered this sell-off here. So those are some things that I look at. I'm really a stats type guy, and I really focus quite a bit on the numbers here. Now looking at some other things that are standing out, we do have crude oil futures off just a little bit. Some of the declines we've got overnight. We had a big boost yesterday. A lot of people calling in, hey, should I add crude oil? Well, it's up $1.40. That's why I sit there and I look at where are the tactical support and resistance levels. If the trend is changing, then I'll start to look at, hey, these support levels, if we're already in an established trend or we get a move that has taken place that is too great in a day, like all of a sudden an outlier, where I look at the average true range. So like on gold, for instance, it's around $43. Silver's 86 cents. Well, if silver all of a sudden moves $1.50 in a day, that's an outlier from the last 10 days average true range, and it tells you that maybe profit taking or maybe raising stops or trimming positions could be warranted, giving this, say, gift that we get with that higher average true range, or that sudden surge in volatility that we get. So oil futures just retreating a bit. The IEA, they flagged a little bit of trade war risks here. Global demand could come off. They thought things might be cooling off just a little bit here, the escalating trade war, and they think that demand's going to come off about 600,000 barrels per day, and that's according to the IEA. So we saw that initial reaction sell off, and now futures are starting to recover, and it shows you the resiliency around some of these mid-60 levels here. Now, natural gas, again, testing $4 about overnight. A lot of people got short in that 450, 460 region here with their stops over 490, the contract high from the day before, and then taking down those stops as we go. So don't forget to use stops and risk manage your positions. But you got any questions, give me a call, 312-858-7303. Remember, futures option trading, it does involve risk of loss. May not be suitable to all investors. Good luck, good trading, go get them. Don't lose a golf ball.